As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. Today we have a very special guest for the first time. Jason Burack, co-founder and CEO of Wall Street from Main Street, is here with us on Reluctant Preppers. Welcome, and thank you for joining us here, Jason.
Thanks, DK. I'm glad to be here.
We've noticed your recent publication, your Wall Street from Main Street 2015 review and 2016 outlook, and I'd really appreciate it after having looked over it, I saw it as such a broad, comprehensive overview of some of the topics that would be of concern to our audience, that I'd like to ask you for some follow-up on some of the details that you have in there.
Well, sure, DK. First of all, I'd like to welcome you to dystopia, because the stuff that's happening in the real world and the stuff that's happening in the markets, it just seems almost every day it becomes more and more dislocated. It's very frustrating for me. I'm a value investor. I like to look at companies that have, revenue increases, earnings, free cash flow, good solid dividend yields without taking on too much debt, things like that. But, you really don't see that in this environment. You see crazy asset prices going up when they really shouldn't. You see phony government statistics, and I'm not just talking about the U.S., I'm talking about pretty much every single country on planet Earth. And, markets where you think that they should be doing well, they're not. And markets that you think should be doing poorly, they're doing well. So I guess it's, it's kind of like that old saying, it's dystopian, but it's where up is down and left is right and inside is out.
Yeah, and that immediately draws to mind some questions that I want to plunge into. But before we do, if you could just give our viewers just a what is the nutshell understanding of what your mission and your purpose is at Wall Street from Main Street?
Sure. We're a financial education and education company. First of all, we wanted to educate people about what we think is really going on in the economy, and that's using the free market lens, which is the Austrian School of Economics lens, which is a lot different than what people are taught in normal business schools and economics textbook, which is normally either Keynesian or monetarist, which is Milton Friedman, although most of it now is Keynesian and they don't even label it as Keynesian. So we're looking at markets from an Austrian school free market perspective. We're looking for market manipulations. We're looking for what is the government doing, what is the private sector doing to cheat or create an edge or create a cartel like the Federal Reserve or things like that. And we're teaching people about how governments are supposed to allow the businessman, the entrepreneur, to, get out of the way, let them invest their capital, low taxes, let them figure out how to add full-time employees and things like that. And, our company now, it's transitioning. We have a popular podcast, and we're transitioning now to an educational technology company. We're in the process of raising investor capital, like on Shark Tank or things like that, for listeners who aren't familiar with the capital raising process. And, we're gonna add a new type of education where instead of people paying, $40,000 or more to get a piece of paper that says they know a little bit about business, they're going to learn how to be an entrepreneur. They're going to learn how to invest in different asset classes from successful people using new types of technology like virtual classroom software, live chat, and things like that. So it's going to be integrated. That's the final business plan once we raise the capital to implement things and set up the website.
Well, we're grateful for you joining us here on Reluctant Preppers, and I'd really like to plunge into some of the topics that you covered in your 2016 outlook. Just in the intro, you were talking about the world being dystopian or upside down, and that's exactly one of the places I'd like to start. 5 years ago, I was reading, no, it was more than 5 years ago, reading a Rich Dad, Poor Dad book by Robert Kiyosaki that talked about the world petroleum markets were going to be going up and up and up, and all the things that were going to be driving that. He said people in China and people in India were becoming from a third world to a first world economy. They were going to want the same comforts that the Western world had enjoyed, which are driven by petroleum, that we'd passed peak oil. That means that the supplies were going to be dwindling and the demand was going to be exploding. And with world populations in those countries growing, combined with the demand that they were going to be providing, that we saw no end in sight to the increases going forward in petroleum prices and so on. And we've seen in the last 2 years, an inversion of that with a glut of supply, dwindling demand, and prices dropping to what people couldn't believe. I mean, the other day, about 2 weeks ago, I was putting gas in the car at a Costco for $1.24.9, and I thought, my gut just told me, this has got to be a near-term bottom. I mean, this has got to be meaningful, because I remember putting it in at almost $5 just a few years ago. So that's the one thing. And the other is precious metals on the opposite. Again, starting from Robert Kiyosaki, Rich Dad, Poor Dad, we had Mike Maloney, his precious metals advisor, talking about the intrinsic value of gold and silver, that sort of thing. A lot of our listeners are very knowledgeable about that, but we've seen what appears to be a complete inversion in that process. As the weaker the world's economies and financial markets and the actual fundamentals of the financials get, and the companies, the more there seems to be a depression on precious metals prices over the last 4 years or so. So if you could just start there with like petroleum and then transitioning into precious metals, and tell us, in your view, what is causing this upside down phenomenon?
Sure. Well, the thing about peak oil, and it's a complicated topic, but the thing about peak oil is it's more a function of price. So is there a lot of oil available when oil is at $20 a barrel? No. Although now, there's a supply glut when oil was in the 20s and 30s, but a lot of that was because there was a lot of cheap capital, thanks to the Federal Reserve, thanks to Wall Street investment banks that don't have to write off their bad oil loans yet, that have tens of billions of dollars in bad loans and bad derivatives bets on those oil loans tied to them and the oil price. They haven't written off those losses. So a lot of the oil that was produced at the 20s and 30s, it was either hedged at a higher price for a couple of years, or it's an uneconomic, and the companies were able, the banks didn't foreclose on their loans and call them in and say, you're bankrupt, you have to stop producing. What happened is the banks have still been giving these oil companies more money, more equity or shares that they can raise. They raised another $10 billion in 2016 already so far, and more debt. So if an oil company has $5 billion or $10 billion in debt, and the bank doesn't want to foreclose on the loan, the bank's going to give the oil company another $100 million or $200 million, because it's a small amount compared to the total amount of the loan, and say, you know what, here's a little bit more money. We know you're basically insolvent. We're going to let you produce oil at a loss for another 6 months or a year, and hope the oil price rises so you can start making payments on the loan again. Also, the banks don't have to write off the loan, because the banks don't have the reserves to cover the losses on the loan. And this goes back to, the problems with fractional reserve banking, with central banking and the Federal Reserve, and debt-based fiat money. But, the oil market, the thing with peak oil is, the fundamentals. There are strong fundamentals long-term. There's emerging middle classes in China, in India, in South America, in the Middle East, in Africa, who in the past, a couple decades ago, they were consuming little or no oil per capita. There was basically no middle class in their per capita terms. And over the long term, that's still going to be true. Now, the oil market, though, markets can get ahead of themselves. Crazy volatility can happen in markets. And that's what has happened. The mindset of the oil market, when the oil price hit 147 and then it crashed in 2008, and then it rebounded again into triple digits, was, the oil market was going to stay in triple digits. So a lot of oil projects were financed with cheaper capital and given capital that should not have been given capital. And we've seen some bankruptcies, but we haven't seen nearly enough. So you getting your $1.20 gallon of gas, I would say, enjoy it while it lasts. It's not going to be sustainable. Maybe it'll happen another year or two. But, if the oil price, we've had a little bit of rally recently in oil. But, if oil price does go back down, and maybe it will, because we haven't seen a lot of oil production come offline yet, we're going to see the oil price start to go back higher. Now, I don't know if it's going to go to triple digits or higher. Markets are irrational for a while. Maybe it will. But an oil price in the 20s or 30s, those oil companies, unless they're being given cheap capital that's backed by the Federal Reserve and Wall Street banks that don't have to write off bad energy loans, those companies cannot produce oil at that price. They cannot make a profit. They cannot generate free cash flow. They cannot reinvest profits back into drilling for more oil and things like that. So a lot of this oil boom, then bust, DK, it's been ridden on the back of, another credit boom from Wall Street banks and the Federal Reserve.
And turning then to precious metals, we've seen this huge, what people thought was the breakout back in 5 years ago. And after we hit approximately 50 in silver, for example, this big suppression of that price. And we've heard a number of guests on our show talk about it being actively, we've had Bill Murphy from the GATA.org on here. We've had David Morgan, we've had others on who have talked about this being actively suppressed price. Is your view, does yours concur with theirs that this has been an artificially paper suppressed price through short selling of contracts and that sort of thing? Or what dynamics do you see fundamentally going on in the precious metals market that explains the curious price action as the economies are worsening around the world, seeing money staying out of precious metals, at least to the extent of affecting the price?
Yeah, there's been a lot of market manipulation. Obviously, there was manipulation before 2011. There was a lot of it before 2011, but really the gloves came off in 2011 and the dirty tricks got even worse. You started to see high frequency trading after the 2008 crash really start to accelerate. And really by 2011, a lot of it had been pretty much perfected by then. So one of the main things that has been meant for manipulating the paper prices, the charts, and it always comes in at illiquid times and at weird trading hours, and it blows out the stops. And the Wall Street investment banks have access to the trading book, so they know where your stops are and your stop losses and things. They know if you're using margin on your futures account, they know how much margin you're using, so they can blow you out of the trade on the long side and force you to either cover your losses on your margin or get out of the trade altogether, and they make profits. But there were so many rules on the COMEX and LBMA, especially the COMEX DK, that were changed in 2011. There were so many margin requirements for people on the long side. There was a lot of cash settlements. So there was a lot of stuff that went on. There were silver shipments. I know someone prior to 2011, in 2008, 2009, that had he ordered a ton of silver, I think, on the COMEX, and it says in their registered category that they have the metal, but he was told he had to wait, I think, more than 6 months to get delivery, which is ridiculous because they claim they have the metal, and yet you have to wait over 6 months for the delivery of your metal. So obviously something doesn't align. There's been my point though is there's been games on the LBMA and the COMEX for a while. And one thing I want to bring up to attention, and we talk about this in our 2015 review, 2016 preview, is that the rules are going to change. So if you think that the people in power are just going to let silver go to 50 tomorrow or gold go to 2,000 tomorrow, that's not going to happen. Now, obviously, they're going to have to let the price go back up, or the miners, the people who produce the metal, who produce the supply, the marginal supply, especially for silver, because that market really has more supply constraints than gold. There's a lot more above ground gold than physical silver. The people who produce that commodity are in trouble. So the prices on those, when we got down to around $13 an ounce silver at one point last year, and around $10.75 gold, you knew that those prices were unsustainable. A lot from a supply-demand fundamental for the physical gold and silver, for the miners that produce this, the primary miners that need to make a profit, those prices, unless they were in currencies outside of the US dollar, they were not doing very well. And even to a large extent, the silver miners who are producing silver in Mexican pesos, in Canadian dollars and things like that, they're still not doing that well. But we've had a big rally recently, and the gold stocks have actually been the top performer in 2016. So maybe people are starting to figure out that as there's very strong physical demand for physical silver and physical gold. We've seen this in the amount of coins and bars that have been sold, and how the refiners have had to really ramp up, well, non-government refiners, because the U.S. Mint hasn't ramped up production, but I'm talking about the private sector refiners have had to really ramp up production to meet demand for coins and bars and rounds and things like that. So I think that that price, when we were there at the end of last year, it was really getting to the point where the paper market manipulation at that level, they were going to have to let some steam out. They were going to have to start the managed retreat, allow the price to move again, allow the miners to start selling some more shares, to raise some capital, to make some profits at their mines again, or things were going to run into enormous trouble. We were going to start to have major supply problems, especially in silver. So it's calmed things down a little bit temporarily, the price rising, but we'll see what happens in the near term because the gold was set for a breakout. It had gone up a lot. It was set for an even bigger breakout if it had gone above 1280 overhead resistance level, and then above 1300 it was set to move to 1400 or 1500 fairly quickly, and now it's in consolidation mode. So we'll see what happens in the next couple months.
Yeah, you mentioned earlier the emerging market economies, and if you could take us a tour there a little bit, because people have told us visiting our channel that you need to, if you want to see the future of the American economy, you can look either to some European examples or specifically some South American or Asian examples to see what happens when countries are even further under the burden of debt, are unable to meet their obligations, or having to manipulate to discount their currency further. So in your 2015 summary and 2016 preview, you did talk about some of the weaknesses that have become just backbreaking to some of these emerging markets. Could you touch on that and what it means as an early warning sign for other world economies?
Sure. Well, I think a lot of these emerging economies and commodity currency economies like Brazil, and I don't want to just single out Brazil too much, although I think they're unfortunately going to be one of the main poster childs for this because they had the World Cup a couple years ago and they have the Olympics coming up in the summer, and they haven't been able to meet some of their budgetary requirements and their things for the Olympics. So people are going to see this on national TV. I don't know how much of the protests and riots that will be outside the Olympic venues that will actually show, but there's a lot of social problems. And the president of Brazil is actually being brought up on corruption charges for the problems with Petrobras. But what we've seen, though, is a lot of these emerging markets and commodity currency countries have borrowed a lot of debt in dollars. That model worked. They were able to pay off their dollar-denominated debt as long as their currencies were strong. China's economy was booming. They were able to export a lot of either oil or energy commodities or base metal commodities to China. So that was their business model. And really, for about a decade or maybe 12 years, that business model worked very well for them. Their economies had a lot of prosperity. The problem is when cash flow drops, when commodity prices fall, you're stuck, and the asset prices fall, you're stuck with the debt still. And your currency is falling. So you have a situation where a strong U.S. dollar becomes even more onerous. So we haven't seen default in these emerging market countries yet. And after some of these oil problems, if the oil market starts going back down, and banks that have bad energy loans, that have tens of billions of dollars in energy loans, start to go bankrupt, I think the next domino, which is the third domino now that we've left the eye of the hurricane and moved into the next side of the hurricane, the other part of the hurricane, is the emerging market debt default that's coming. But there's a difference, though. The emerging market countries, the U.S. still has some entrepreneurship. Now, obviously, there's a lot of people in the middle class struggling due to inflation and taxes, and there's a lot of people out there with student loan debt and other types of debt that they can't find a high-paying full-time job to pay off the debt and start a family and things like that. We're in a situation where the U.S. economy is becoming a have and have not. So if you're a technology entrepreneur, you come here from another country, if you can do computer programming code and speak multiple languages and things like that, you can probably go to Silicon Valley or work on Wall Street as a computer programmer with some of your other skills. You can get a high-paying full-time job. But, that's going to be a very tiny percentage compared to a lot of Americans here who, have a college degree and it's not in the right subject, and, they're trying to cobble together a couple part-time jobs. So I don't know if the U.S. is going to completely end up like Europe. There's a lot of similarities to what's happening in Europe. There's a lot of cultural Marxism here in the United States. There's a lot of, obviously we see that now with the popularity of politicians like Bernie Sanders. It just frustrates me, DK, that there's people out there who want a better economy, who want to blame absolutely everything on the banks, and yet they don't understand that if they vote for Bernie Sanders, maybe he'll give them a couple social programs or something, but their tax bill is going to go through the roof, and it's going to destroy their standard of living even more. So there's a lot of book smart people here in the United States that just don't have common sense. And, I think there's some similarities from some of these other countries. The U.S. still has some entrepreneurship still. And, even the shale oil boom was an amount of entrepreneurship. So we've had a situation where the U.S. would have already collapsed were it not, in my opinion, from the Federal Reserve, the shale oil boom, which is now in collapse, but the 6 or 7 years the boom went on, it bought the U.S. time to say, look, the economy is growing, we have high-paying job growth, things like that, and also Silicon Valley. So if it were not for those few things, the U.S. would have already probably collapsed already and looked like a third world country. But that doesn't mean we're not on the road to serfdom, and the middle class is not being, in my opinion, I think the middle class is being intentionally destroyed.
Well, now you mentioned shale oil production as a unexpected or unpredicted prolonger of prosperity or apparent prosperity in the U.S. We've had the opinion expressed that the low crude oil prices from the oversupply released by Saudi Arabia is actually used as an economic weapon against competitive producers such as Russia or even North America. Is that your view, that the oil prices are being intentionally set to squeeze out competition?
That's a great question. There's a lot of geopolitical stuff behind that. There's documentaries out about this and books about this. One of the books is called The Oil Card. It was actually out just as the shale boom was getting going. And the guy basically said the oil price is manipulated higher by the Russia and OPEC and the Saudis, and that the oil price should be much lower. And then there was another documentary out about called Houston, We Have a Problem. And that's basically how the U.S. set a trap for for the Soviet Union in the 1970s and 80s, and how they got the Soviet Union to, as the oil price was going up in the 70s, to take on a whole bunch of extra debt. And then they went to OPEC and Saudi Arabia and intentionally knocked the oil price down to bankrupt the Soviet Union. And it took like over a decade to help bankrupt the Soviet Union. So, I mean, obviously there's precedent there that there is games played in the oil market. I don't think all of this was manipulation while the oil price went low. The shale producers, like I said, they're funded by way too much cheap credit. And that's a big problem. You know, there's people here who are still producing oil, who are not making any money and still hanging on and getting access to capital they shouldn't. But I think initially there was some manipulation involved where maybe either the U.S. went to the Saudis or OPEC and said, you know what, we want to hurt Russia, we want to hurt Putin. And they didn't maybe think it fully through. And maybe OPEC didn't think it fully through. I think there was a situation here where OPEC honestly thought that they could bankrupt the shale producers, the U.S. guys, at maybe $65 a barrel oil or $50 a barrel oil if they kept it there for a couple months. And, you know, with the trend traders, these computer trading programs on Wall Street, these markets just get way out of control. So once a trend is established up or down in a market, things just have a life of themselves nowadays now. So the markets are increasingly volatile. And, you know, what's rational to you or me or to someone who has 50 years of market experience, the markets are not going to do that. So we may have a situation where the oil rally, you know, sputters out and the oil price goes back down into the 20s for 6 months or a year or something like that. Then we have a whole bunch of supply wiped out, and the lowest cost producers, who are the Saudis, and maybe Russia survives, and a lot of the other oil producers shut down or consolidate or temporarily turn off or things like that. But we're in a situation when the oil price was, you know, in the low 30s or high 20s, where 90% of all the global oil supply was very uneconomic. So, I mean, from a supply demand standpoint, that's just unsustainable with manipulation or not. This is a thing like with gold and silver markets. When you get to a certain level, and, you know, the people who are out there saying, oh, gold's going like Harry Dent, gold's going definitely to 500 or 400 or something. Well, maybe for a month or something, gold can go down there. But I look at the all-in production costs of gold miners and things like that. They don't have gold mines anymore, really, that can produce at all-in sustaining cost levels of that. And these companies have debt. So I don't know how there would be any supply, how any of these companies could survive prices that low. You'd be looking at, you know, a supply shock, a squeeze, very quickly then. Prices, you're in a situation where a lot of these commodity prices cannot stay low. I just read an article recently, a couple days ago, how, you know, if the copper price has crashed in the last 12 months. If the copper price doesn't go up a lot, we're looking at a lot of the copper producers going bankrupt in the next year or two. So we're in a crazy situation now with the commodity producers, where, you know, if the commodity price keeps going lower and lower, we're going to have supply problems in the near future.
If we could bring you back to the topic of China, I saw an article several months ago that talked about sort of this double bookkeeping method that's been going on in the local and regional economies of China. People have talked a long time about China as the powerhouse of the world, as far as the biggest manufacturing center and growth in solar and all kinds of exports, positive trade balance, etc. But they're saying that behind the scenes, that not only is there a greater debt than anyone's admitted at the national level in China, but that all of the local and regional governments are also heavily underwater. And when in your report, you talked about sort of like people looking for a sign out of China and finally seeing some really significant movements happening recently. If you could zoom in a bit on China and tell us what's going on there.
Well, there's certain things I like about China long term and certain things I don't. Their government, I'm a libertarian, I believe in free markets. There's a lot of the Chinese government does not believe in any of these things. They block Google, they block Facebook and Twitter. They don't allow freedom of speech in many cases, pretty much every case actually. And the Chinese government really fears Twitter because I guess Chinese people can meet up and they can come up with a demonstration plan or something like that. So and I also don't like central planning of China. There's a lot of Keynesian economics in China. Now China is accumulating a lot of physical gold, but they're stealing their citizens' purchasing power, DK. So all that money that could be in the emerging middle class person's pocket in savings and increased purchasing power for the emerging Chinese middle class, they could have a lot more of that. And instead, what the government has done is the government and central bank there play games with their currency, and they take a lot of this excess purchasing power that their citizens could have, and they instead put it into their sovereign wealth fund. So the Chinese government can manage it because I guess they don't trust their citizens. And so, they have a situation where the Chinese government is stealing purchasing power from their citizens and allocating capital. You're exactly right on the amount of debt. No one knows the exact number. So it's definitely in the trillions. There's central planning there. And I think what's going to happen, unfortunately, for a lot of the Chinese people is the government, because they're Keynesians, because they came to the U.S. Universities, top U.S. universities, they worked on Wall Street, they went to the top schools in London, like London School of Economics and Cambridge and Oxford and things like that, and they learned it from U.S. and British economists, basically Keynes, that, they're going to do mercantilism. They're going to drastically devalue the currency at some point. They're going to print a lot more money probably and just wipe the debt away. They're going to say, you know what? That debt, it's not valid. We're going to print more RMB. Most of the RMBs in our country, yes, they have some offshore, and they're going to say, tough luck. The Chinese citizen, on the other hand, the things I do like about China is the Chinese government, they do have normally lower taxes. So from an economic standpoint, the Chinese citizen, the guy who has an idea to create a business, he has the ability now to go in there. So longer term, we're talking over the next decade or two, China has a very long history of good entrepreneurs. They've invented many things over the years. And yes, there was 40 years of communism from 49 to the 72. To President Nixon went there and started opening it up, and it hollowed out our industrial base and the factories moved in, things like that. But that small blip there where China was full communist and they didn't allow any type of entrepreneurship really, that's a small amount of history in the whole scheme of things in China. I enjoy history. I look back through Chinese history, and I really like how long term the Chinese people are a very entrepreneurial people. There's always been corruption. The Chinese actually, DK, invented paper money. I don't know if you knew that. They actually invented paper money, so they were using a fiat currency. They were inflating it before anyone else. Believe it was the Tang Dynasty. So they actually have a long history of that. That's why their people are more attuned to, keeping insurance, saving in precious metals. So China doesn't have, they have problems with intellectual property, although, as a libertarian, I would prefer that people don't have to be able to make money on patents and people can make money other ways. But a lot of businesses are scared to invest there necessarily because they're afraid they can't patent their things, their trademarks and intellectual property and things like that. I think China, over the next couple decades, they will adapt to more market conditions and they will become more pro-business. In terms of freedom, though, like the other civil liberties and things like that, I'm not quite sure how China's going to... I would like China to become more of what America used to be, but I don't know.
Now, turning back to the United States, if we could look at a U.S. stock market, we've heard it said, and this was even back during the dot-com bubble, people were talking about the four horsemen of the NASDAQ, in terms of it was Amazon and eBay and Microsoft and Apple. But what you're seeing behind what's propping up the U.S. stock market? We've been told by other guests that it's a few sort of headliner stocks that are masking what's really going on with the broad cross section of other companies, and you touch on that in your report as well.
Well, what I would say for your listeners out there is if you look at earnings for a lot of different companies, the earnings are bad. So there's a few exceptions here or there, but a lot of the consumer companies, so the retailers, the housing companies, the restaurants, the people at malls, so the retailers, the numbers are not that good. They're coming in below expectations. And yet the general stock market indices, so the Dow, the S&P 500, the general market indices seem to keep rising. What we wrote about in the report was FANG, which is Facebook, Apple, Amazon, Netflix, Google. Those specific stocks were responsible in 2015 for a lot of the stock market rise. So the rest of the other companies were not doing well, and those ones were, and those make up a large chunk of the stock market indices. But I think there's something more nefarious going on behind the scenes. I think there's an active effort by the powers that be, whether it's other central banks like Japan doing currency swaps, trying to help prop up the U.S. bond market and the U.S. stock market, devaluing their own currency to bring more liquidity to the U.S. markets, or the plunge protection team in the United States, which is either the Exchange Stabilization Fund or the Working Group on Financial Markets. There's a couple different plunge protection teams, depending on who you speak to, or the Bank of International Settlements. So there's a bunch of different groups involved, and I think there's been a concerted effort to try to keep those indices up while individual companies fail with their earnings. The other thing that's been going on is, thanks to cheap capital that is sponsored by the large banks and the Federal Reserve here in the United States, there's been a ridiculous amount of share buybacks. And this is by, greedy corporate executives who are myopic, trying to pad their pocket to beat, top and bottom line numbers every single quarter, so they can trigger stock option numbers and stuff like that. It's leaving the companies longer term in a lot worse shape. They're not spending money to create jobs. They're not investing their free cash flow into, research and development nearly as much. They're not making prudent acquisitions to increase market share or investing in new types of industries. They're not really doing that as much. So there's been a lot of gamesmanship on just defending the stock price for a lot of the larger companies, and it's being done with this. I don't know if it's being done intentional or not, but one of the unintended consequences of the Federal Reserve keeping credit so cheap is that these guys are able to take that cheap capital and buy back the stock and boost the stock market prices higher. And, that's not sustainable either. I don't know how much longer it's going to last. We wrote in the report, which your listeners can go to wallstreetformainstreet.com and download for free in exchange for an email. If they want to read it and send feedback to us, they can email us for feedback too, if they have any questions about the report. But we wrote in the report, we'd be surprised if the stock market didn't crash by around election time. But every time I look at the technicals, and this happened in 2015 too, around August, and it's happening again now, when it looks like the technicals for the regular stock market indices are about to break down, something just comes and knocks the regular stock market indices back up. But I think the divergence, the bifurcation that's occurring is in the individual companies. So what the analogy I like to use is the people in power who are going to try to save the indices for the Dow or the S&P. They don't care if the Olive Garden stock collapses, but or if a retailer collapses, a couple retailers go bankrupt, but they care about the index. So the average guy on Main Street, the guy who only checks his account once a day from his regular broker, or he watches CNBC or Bloomberg, and he says, oh, the Dow's up, oh, my account's up, oh, everything's fine. Oh, I'm getting my dividend check, everything's fine. So he won't question what's wrong. So there's a lot of effort behind the scenes to keep those indices up, and they don't care if the individual companies fall they'll just take them out of the index as long as the index stays up.
Yeah, and you mentioned the easy money policies from the Fed are partly what's fueling this. If you could talk about that specifically, what is going on with interest rates from the Fed and what is likely to play out in the next year? We've heard a lot of speculation over the past year about the Fed cannot stop quantitative easing. They can't raise interest rates, and yet they did do a 0.25% raise recently. So what does that mean, and what is the outlook, in your view, from a common sense standpoint regarding interest rates and what it means to the average household, the average individual?
Sure. So I think if the Federal Reserve tries another couple interest rates, and they'd be stupid to try it at this point because of how leveraged the system is, but if they do try it, something in the economy is going to break. Maybe there's going to be a bond default by a large oil company that no one expected. Maybe a couple banks like Deutsche Bank or a few others will go bankrupt. So there's going to be something in the economy, based on my estimates, either someone who's too leveraged, who has too much debt, who doesn't have enough cash flow, or whose assets has fallen and they don't have good debt to equity ratios. Though one of those really large companies is going to break. The banks are not going to be able to cover the losses. They're going to need a bailout. And, there's going to be coordination. There's already coordination with central banks, but there's going to be even more coordination than with central banks, to where, they're going to say, we're not going to allow this company to fail. It's going to be too big to fail. We're going to give them, some type of bailout, or we're not going to default on their loan immediately, or something like that. In terms of negative interest rate policy, we wrote about this in our report. Before we talked about 2016, I really think your listeners should understand Austrian school economics. And one thing, even people who are libertarians who say they know Austrian school economics, there's still people, unfortunately, too many people who defend Keynes. I talk with libertarians, I talk with people who claim to be Austrians, and they still defend Keynes, claim there's no way Keynes would have gone for any of these policies right now. Go to our report, read the 3 books we recommend, which is Where Keynes Went Wrong by Hunter Lewis, Henry Hazlitt's book called Failure of the New Economics, which goes line by line through Keynes's general theory, and also Murray Rothbard's book about Keynes's policies, and also it's kind of a short biography on Keynes, what type of person he was, how he made money investing, hint, hint, market, hint, hint, he traded routinely on government inside information from his government positions. Keynes, the quote out there is that Keynes bashed gold and, it's a barbarous relic. Well, one of Keynes's biggest investment money makers of his career, he leveraged to the hilt. He knew that FDR was going to devalue the dollar against gold and, basically essentially confiscate gold and force Americans back into the dollar. He had inside information of that, him and other people on Wall Street. And he leveraged to the hilt and bought lots of gold stocks. So, maybe in public he bashes gold or says, it's a barbarous relic and we should never go back to a gold standard. In the meantime, one of the biggest investment moneymakers of his career was in gold stocks. So I think people should go back there and understand that if they really go through the general theory, and there's part of this in the epilogue, and he talks about euthanizing the rentier. He actually goes off on a rant. There's some really crazy stuff there. We're talking like almost full Marxist, really full-on crazy James Bond villain type of stuff Keynes said in there. One of the craziest things he says at the end in the epilogue is he wants to euthanize the rentier, which is basically just make one of the things about capitalism and capital is it's derived from savings. It's supposed to be scarce. Capital money is supposed to store purchasing power and save and be savings and things like that. And capital is not supposed to be necessarily easy for you to have access to. Keynes basically wanted to turn that on its head. He wanted to make capital easy, cheap, plentiful, almost unlimited, and he wanted to euthanize the rentier class, so the people who had worked hard all their lives to save, who had done the right thing, who had produced more than they consumed and delayed gratification and things like that. Keynes said those people were bad for the economy because they weren't working and earning a wage. So I'm not surprised at all at negative interest rate policy. Keynes would have been an advocate for something like this because if you go through there and read some of the crazy stuff, he wanted a one world currency. He would have been basically in favor of a one world government, and he wanted cartels formed for control of commodities and things like that. And he mentioned this in the general theory, and a lot of people say, defend him and say he never said any stuff like this.
And before we let you go, since it is the election season in the U.S. with the presidential race hotly contested and diverging views on how that might impact the future for our country, if you could just weigh in on what you see the major dynamics at play there, and what if you think this is a foregone conclusion, it's already a wired outcome, or how you see that playing out, and what the key difference will be that comes from that will actually impact the way that events are going to unfold here.
Well, I think Hillary should have already been charged already. I mean, she's committed. If you read Roger Stone's book, which talks about the Clintons, it came out recently, he talks about a lot of the things that the Clinton family has done. So Hillary's a career felon, and she's basically been Teflon coated for a while. She already should have been charged, and she should be on trial already for what she's done with the email scandal. It seems pretty clear to me. The FBI, there's been people in the FBI that have admitted it. I live right outside of D.C. I live like about 20 minutes from Washington, D.C. in Northern Virginia. And I know people who work in the government and government agencies. I know people who work in the Justice Department, not super high up, but, prosecutors and things like that. And a lot of them are, feminist women who vote for Hillary. So and she has a lot of supporters, a lot of people who love her that think, she does all these great things for women, and they're willing to overlook all the crimes and other stuff she's done because they love her, because they think, she's advancing the cause of women. And I think that's why that, she hasn't been charged, and she's not on trial and or convicted yet. So I think the longer they wait, I think the more likely it is she's going to win the nomination. There are a lot of popular grassroots people who do love Bernie Sanders, but, I don't think the corporations would accept Bernie Sanders. So I think they're working on sabotaging Bernie Sanders behind the scenes, and pretty much every single corporation is working on sabotaging Bernie Sanders. I personally think the election's going to end up Trump versus Hillary. It's looking that way. A lot of the corporations are not necessarily in favor of that, although, Wall Street and a lot of corporations are in favor of Hillary. But Hillary is like the lesser of two evils because they know that they can control her because she can be bought. Trump is not necessarily one of those, although Trump is, hired lobbyists and is a crony capitalist. We're in a situation here where, unfortunately, DK, I think for the average guy on Main Street who wants more freedom and lower taxes, who owns a small business, I think regardless of who wins, they're going to get screwed for the most part, especially if Bernie Sanders wins. But, I think in general, the U.S. debt is a runaway train. I don't think at this point any single politician, even if Trump wins, I don't think Trump could. He would probably fix the real economy a little bit to create some jobs, but he would create, government jobs for either, forcing illegal immigrants or building a wall or some of the other programs he has in mind. So I don't think the real economy in the United States can recover until the debt problem is dealt with, until we get back to a situation where wages and prices are allowed to fall, where taxes are slashed. The small businessmen on Main Street, and I talk to a lot of them, they're getting 50 or more job applications for almost all their full-time job. So there's a labor surplus right now. They're scared to deal with the taxes that are coming with the Obamacare tax and things like that and other hiring taxes. So it's one big global problem, and I don't think the election is going to solve it. Unfortunately, in the short term, I think things are going to get a lot worse before they get better. I think in the long term, though, what I'm seeing on the internet with your podcast and my podcast and Elijah Johnson's Finance and Liberty, I think these are good things. I think these are bringing interesting conversations to the table. People who would have never thought of anything libertarian or anything like that before, they're at least engaging in interesting questions. So I think that long term maybe is good, but I think short term, I think things are going to get a lot worse before they get better, both in the real economy and also for our freedoms and liberty, until more people start to wake up and understand what's really happening to us from our freedom and our purchasing power being stolen and the problems with the Federal Reserve and money. You have an interesting channel name. I like it. It's Reluctant Prepper. I think some people get too much into prepping and think everything's going to end. I think the prepping is good for like 1 to maybe 6 months. We could have some problems, but then they're going to roll out we were discussing this on the Welcome to Dystopia we recorded today, and one of our guests today said, central banks are all going to roll out digital currencies, and the government, there's not going to be central banks anymore after that happens. And he said, that governments are going to have, the blockchain code. They're going to have their own separate ones, and they're going to issue all the credit. So there's going to be government banks that are going to replace regular banks. And he's like, basically, if you've made a bad social media post or something like that, even if you have a good small business, they won't give you a loan. That's what he's predicting. So he was like, even if you can post collateral and you have a small business making money and you have collateral you can post on a loan, you need a loan. He's like, they'll say, well, you made this social media post or you did this podcast and we're not giving you any credit.
So the complete centralized control of access to credit.
Yes, the government to a smaller extent has done this already with Edward Snowden and Julian Assange because they were, big rebel rousers. So where basically the government just said, you know what, you're creating too much of a stir, you're telling too much truth, you're releasing too many secrets. So we're just cutting off all your bank accounts, so your credit cards, your checking account, your savings account, nothing will work for you anymore. Your accounts are all frozen. You're done. So I think if the government can get, full control over like digital currency and things like that, the way things are heading is they may start shutting off people like us if we become too popular.
In other words, centralized government controlling all access to credit is really a way of stifling free speech. It's a way of stifling freedom. So
well, China's working. China's actually working on this right now. I don't know if you saw this in the last couple of months. They're working on a new credit score type of rating where they have in their algorithms, they have monitoring of your social media. So if you've made anti-government posts on social media or organized an anti-government demonstration or attended a rally, like it said on the Chinese version of Facebook, it said you went to an anti-government rally or something, they ding your credit score a lot and they make you pay higher interest rates or you have no access to credit then. So I don't know if the U.S. is going to go, how quickly it's going to go there, but at some point this is all one big disaster. Like what I was saying, I don't know if you've listened to what I've said in the past with the currencies. There's trillions of dollars in currency swaps being printed right now to keep up a lot of the markets and prevent governments and banks from failing. I had got that from a good source a couple years ago in 2014. I was told basically in 2014, all the major central bank representatives were all at this IMF meeting in DC, and all the each Treasury Department from all the major economies all had a representative there, and they were doing presentations, and they basically just said that the system can collapse at any time, and the only way we can keep it afloat is with currency swaps right now, and we're going to print unlimited amounts of them.
I definitely did see a few years back in the U.S. when the Dow was breaking down through some support levels and really looking like it was going to plunge. And overnight, this bizarro thing happened where the Japanese central bank, I forget if they were purchasing dollars or were selling dollars or whatever they were doing, and suddenly the markets were back up the next morning. It's just like, what just happened there? Because it seemed like something totally off the radar of what you would have expected from normal traditional market action based on, people actually paying attention to what's going on with the companies and the profits and that sort of thing involved. Definitely seemed like external intervention.
Normally what the Japanese government does is the Japanese government purchases treasuries because the British government used to do this when they were an empire, and Rome used to do this too, is basically you pay protection fees. So they're paying tribute. So basically, after World War II, the U.S. government forced Western Europe, so Germany, England, those countries that it saved, and also Japan, to start buying U.S. treasuries in exchange for their defenses, so for NATO and things like that. So normally what happens is Japan buys U.S. treasuries, and they have to print more yen to do it. And in the Wall Street investment banks and the other hedge funds that are, billions of dollars enormous, they can borrow the Japanese yen even cheaper because it's going down. So they can borrow very cheap because Japan's manipulating their interest rates, and then they know the yen's going to go down. So they borrow the yen now, and then they invest it into the U.S. stocks, and they figure they can pay back the yen later at a low interest rate in cheaper yen. So that's the computer trade. Turd Ferguson actually said there was a complete 100% correlation between when the yen goes down is devalued, when the yen goes down against the dollar, and the U.S. stock market's going up. I don't know if it's still 100%, but he said it was like a year or two ago.
And that brings us to our last question of what can an individual do in the face of all these unfathomable forces that are out there to secure their own wealth, their own well-being, their family's livelihood, to protect themselves from these situations. What are some of your recommendations, either from your 2016 forecast or from just your own common sense view of what an individual can do to try to position themselves the best at this time?
Sure. I think the first thing is education. So you have to understand you can't trust any one expert. Just because the guy has gotten things right for the last 5 or 6 years in a row doesn't mean he's going to get things right for the next 6 or 7 years after that. And things are changing so much behind the scenes. There's so many new rules and regulations going into effect. There's new market manipulations. 10 years ago, look at how much high-frequency trading has made it a lot more challenging for people to trade stocks every day with the way things are. So there's a lot of technology changing. There's a lot of rules changes. There's a lot of lawyers behind the scenes, whether it's corporations or politicians, the government agencies, special interest groups. People are working behind the scenes to change the laws. And as the guy on Main Street, it's going to be tough for you. So unfortunately, there is no more buy and hold, set it and forget it strategy. Even if you own a lot of physical gold in the United States, it's dangerous because we don't know if gold goes to 3,000 or 5,000 or 10,000 an ounce. We don't know if there's going to be a windfall profits tax or confiscation or anything. The rules are going to change quickly. That's something I stressed. The rules are going to change a lot going forward, and it's going to be difficult to follow all the rules changes. And I think that's something that people need to understand. So people need to keep educating themselves. And also, they cannot put all their money into one country, and they cannot put all their money into one place. So I love physical gold and silver. I think those are key. But storing all of them just in the United States or just in your house or just in your backyard or wherever else, it's a dangerous game. It's a dangerous game that's going on. And, we're all as smart as you and I are and that your listeners are, we can educate people and stuff like that. We don't have a lot of say in what the politicians and the bankers and the people running these corporations that can hire the best lawyers, we don't have a lot of say in policy decisions for them. So I think having some cash out of the system now before with negative interest rate policies, if your listeners have some cash, they should have some of it out of their banks and have that handy. They should obviously have some ammunition. If they have a lot of physical precious metals at their house, they should have guns and ammunition. And, obviously you should have gun locks if you have kids around. You don't want any accidents still. But, some Bitcoin for a speculative purpose is not bad. And I think investing in different countries is not bad, depending upon the valuations you can get. So the gold stocks, I think, if you know what you're doing, as long as you don't buy too many bad junior mining companies, you can buy gold stocks right now that are still going to make pretty good money. You can get diversified into Australia or Canada. I think that's a way for the guy in the street to start moving his money out of the United States into other additional countries and say, you know what, I own some physical gold here. I own some physical gold with BitGold in a couple different countries because they have cheaper storage fees and I can take delivery anytime I want. I maybe store a little bit of metal, a little bit of silver in another country, and I own some gold stocks and things like that. And I think, some prepping is obviously not a bad idea. If we have the banks shut, and obviously I think this negative interest rate policy, I think it's designed to maybe stop bank runs, but it may accidentally cause them anyway. So if we have a situation where we do have the bank shut down, obviously you want to have cash or something you can trade for food and other things you need in addition to supplies like batteries and food and some basic prepping for 1 to 4 months, maybe, I would say.
Well, Jason, we've heard you over the years on various channels, and just grateful for the efforts that you and your team are doing to bring common sense and solid values to allow people to really take care of business for themselves and not be just subject to the whims of these extortion forces that do not have their best interest at heart. We're glad you're here with us, and just thank you for joining us on Reluctant Preppers. If people want to find out more of your work and access some of that education that you offer, where can they find you?
They can go to our main Wall Street for Main Street website. That's WLSTFORMAINST.com. And they should definitely go there and download a copy of our free reports, 25 pages. There's some stock picks in there. Some of them are gold stocks that are generating cash flow right now that are doing pretty well. Some of them are oil stocks that even if the oil price goes lower again, the companies will survive and they will buy assets. So, those are interesting ideas. And they should check out our podcast, which has over 8,000 subscribers on YouTube and over 1.4 million views.
Well, Jason Burack from Wall Street for Main Street, thank you again for joining us here on Reluctant Preppers.
My pleasure.